Dear friends, ladies and gentlemen, I'm pleased to be here with our Chief Economist, Laurence Boone, to launch our latest economic outlook. This is the OECD Economic Outlook for 2019. Now, it's certainly possible to see the glass half full. Unemployment and inflation are low. Global GDP growth, although it's lower than in the last couple of years, is projected to be 3.2% in 2019, and it will edge to 3.4% in 2020. But our message is strong and is simple. Let's avoid complacency at all costs. Although usually we discuss a number of downside risks to the outlook, but clearly the biggest threat is the escalation of trade restrictive measures. And this is happening as we speak. Growing trade tensions drive uncertainty. Thus, business investment is hit and global growth is stifled. This, in turn, will undermine people's well-being. Jobs will be disrupted. Consumers' purchasing power will be hurt. And this clear and present danger could easily have knock-on effects. Prolonged uncertainty about existing or even further trade restrictions could heighten volatility in financial markets. Now, why am I making the connection of these two? Well, now there are literally trillions of non-financial debt that was issued by institutions that, corporations. Well, more than half of that is actually just above the investment grade limit, just close to the line. Now, this means in the face of a systemic shock, like, for example, an increase in trade tensions, or then hundreds of billions of this debt could migrate for no reason of their own, but because of the systemic shock, down to below the investment grade. And then, of course, you know the story. Investment managers have to sell the paper, and then you create a big mess in the markets. And then, at best, some of the firms would have to increase the price they pay for debt, but many would simply not have access. So, you're talking about a pretty serious consequence. This is a risk. It's not going to happen necessarily, but it's a risk if we continue down the same path. The other one is, of course, China's growth, which we see naturally coming down from 6.2 to 6.0. Laurence will tell you in detail about it. But in the face of escalated tensions on trade, would then probably be greatly affected. Then the growth could go below 6%. Well, the question is, already in the last quarter of 2018, the imports of China actually had negative growth. And in the first quarter of 2019, the imports of China were flat, which means already this deceleration is having practical effects, day-to-day effects, on a number of countries that depend on exporting to China. So again, the connection between increased trade tensions and the growth of a particular country, which is one of the largest economies in the world, one of the largest trading nations in the world, and again, the impact that this would have on dozens of other countries. So this knock-on effect is very, very important. And I've just mentioned, a few of the possible consequences. So the world economy today is not in a good place. Unless there is a de-escalation of trade tensions, the outcome could be much worse than the projections that you're going to talk about in a moment. Global trade growth has already fallen markedly. This is the growth of trade. Growth of trade, not of GDP. Now, it was already recovering. It was 5.5% in 2017. Well, this year it's going to be 2.1%. 3.1% next year, maybe. It should be about 7%. It should be double the rate of growth of the world economy. That's the rule of thumb for the growth of trade. It should be a locomotive, pulling the trade, the growth, the GDP growth. And now it's not working like that. Now, the effect on investment is pretty easy to understand. Why do we invest? We invest to produce. And why do we produce? Well, because we want to sell the stuff. Make a buck. Make some money. But what happens when you don't know whether you are going to have access to the market? Or when you don't know at what tariff you're going to have access to the market? Whether it's going to be 0 or 10 or 25% or no access at all. Then what happens? If you are a responsible investor, or you are linked or constrained by the shareholders of your own company, then you will refrain from investing because of the uncertainty. And what happens when you don't invest? Well, investment is the seed of tomorrow's growth. When you don't invest today, you have an impact that is quite fast, but certainly an impact in next year and the year after. So it's a question of logic, Even consumers in the face of uncertainty, what do? They save. They forgo the consumption. And consumption is the growth of today. So you have uncertainty breeding this blockage of growth for both immediate and for the future. We must reinforce transparent, predictable, rules-based trade. Now, waves of trade liberalization have benefited people from all over the world. Billions of people have lifted out of poverty because of trade liberalization. New industries, new markets have been created across the globe. So there is an urgent need that we sit around the multilateral table and that we create the conditions that will allow trade to continue to underpin global growth and global well-being. Now, this is about the size of the growth, the level of the growth. What about the quality of the growth? Well, productivity growth has remained low in the OECD, despite the upside potential. I mean, we've never been as developed in terms of digital and knowledge and science and technology. But regardless of the digital revolution, GDP growth in OECD economies has been largely driven by rising employment. Much of this employment, however, is low-quality jobs, relatively low-paid jobs, and that hinders aggregate demand, and it also hinders productivity. Because, again, uncertainty and the fact that you're getting low paid, etc., affects your consumption capacity. But it also, if you add to that the level of informality that is developing in many countries, it adds to low productivity. So now people in these low quality jobs are generally not getting enough training to reap the benefits of the digital transformation. And that is raising the prospects of widening disparities in income and well-being in the future. We are planting the seeds of greater inequality today, and that will manifest itself tomorrow because we are not solving the problem of the skilling of the workforce. So, dear friends, all is not well. But let me assure you, we're not only drawing attention to how empty the glass is, we're also making recommendations on how to fill it. Across a range of key economic policy areas, we're coming forward with solutions. We're leading international efforts to agree on how to tax corporate profits in an increasingly digitalized economy. Tomorrow, we are adopting new principles on the use of artificial intelligence. We've come forward with policy frameworks for inclusive growth, for sustainable development. The I Am the Future of Work initiative covers all the angles of the challenge of creating more, yes, but also better jobs. And the list goes on. Today's economic outlook is part of that across-the-house effort, with recommendations on how countries can achieve stronger, more inclusive, and more sustainable growth, and how they can better exploit the potential of digitalization. So, I remember when Pascal Lamy was asked whether he was optimistic or pessimistic, and he said, "I'm activistic." That's what we have to be, activistic. A lot of work to do, but as Laurence will clearly tell you, that if we do it together, we'll have a much better chance to succeed. Thank you very much.
Thank you, Secretary General, and welcome to everyone. Let me now go into the details of the outlook that was painted by the Secretary General. 3 key points. Global growth has slowed sharply over the past years, and it's set to remain weak. Trade growth has plunged, and investment has slowed. Job growth and wage increases are still supporting consumption, but living standards have not fully recovered from the crisis. Today, as you may know, we are celebrating 20 years of the OECD Forum, so let's take a look backwards. It's been a bumpy road, and there were 2 crises. The bursting of the dot-com bubble in 2001, after which strong growth resumed soon. But of course, the global financial crisis, the worst economic crisis since 1929, precipitated by a fall in the US housing market and excesses in finance. Since then, instead of a swift recovery, and in spite of strong central banks' support, growth has been stuck at relatively mediocre rates. So where are we now, and what do we expect over the next 2 years? After global growth peaked in 2017, slightly above historical average, trade tensions have derailed growth. Global growth has slowed since last year and will only reach 3.2% this year. And for 2020, we only project a modest pickup to 3.4%. That means growth is still set to remain weak by historical standards. Let's now look at the key regions and countries. First, let's start with things where things are going relatively well. That's the US. Growth remains fairly solid and the labor market is strong, but already growth is projected to moderate in 2020 with the boost from tax cuts fading. Higher tariffs are increasing business costs and consumer prices also in the US, and demand is waning. Then let's move to emerging market economies where the overall situation has improved, thanks in part to better financial conditions. But even there, the picture is contrasted. Some countries fare well, like India, which posts the fastest growth amongst G20 economies. Some countries are recovering, like Brazil and South Africa, even though they have their own domestic challenges. Others, like Mexico and Argentina, are projected to gradually recover from last year's turmoil, but their recoveries are fragile, and they need to continue stabilizing policy action to restore confidence. What about Europe? I fear I squeezed Indonesia, and please apologies. They're also stabilizing, like Mexico. I'll go back to Europe. The euro area economy has slowed down markedly since mid-2018 and will stay weak. The trade tensions have disrupted the manufacturing sector, hitting Germany and Italy the hardest, but that diffuses because value chains are highly integrated across the continent. And while unemployment continues to decline, policy uncertainty, Brexit, weak trade, low confidence are all a drain on growth. So now, let's go to Asia. And you can see here that Japan has been in a low growth situation since the 1990s, and that will likely remain the case for the next 2 years, because exports are hit. And Japan increasingly suffers from shortages of workers due to an aging population. And then there is, last but not least, much uncertainty about China. As you know, China had a period of phenomenal growth, but it's been slowing down. It's normal, it's catching up with more advanced economies, but the economy was weakening faster than expected, so both fiscal and monetary policies have been eased. However, how effective these measures will be remains uncertain. So to recap, growth may have bottomed out already, but the pickup we're projecting will not deliver growth that is robust, sustainable, and inclusive. To put it bluntly, and as was highlighted before, this cannot be the new normal. We can't be satisfied. We can't accept an economy that doesn't raise people's living standards. So before I turn to policy recommendation, let me highlight some risks to this rather bleak outlook. the main and most urgent issue is the weakness of global trade, and particularly for Europe and China. Tariff hikes, and even more the climate of high uncertainty that the trade disputes have created, have undermined confidence. Firms have shelved their investment plans. The manufacturing sector has been particularly hit. And the sharp deceleration of trade since last year mirrors the rise in policy uncertainty. And as you can see from this graph, in the first 2 months of 2019, global trade has barely grown at all. Look at the little tiny bar which is at the bottom of the chart. And this could get worse if the escalation of trade restriction continues. The tariff increases up to 25% will affect many products that consumers buy routinely. We estimated the impact of such new tariffs on trade and growth. First are the measures that have already happened and which will be implemented soon. If these tariffs are maintained, they will shave 0.2 to 0.3 percentage points of growth in US and China, and they will add 0.2% to US consumer prices. Next are the additional losses that would come from extending the 25% tariffs to all of US-China trade. And finally, if we take into account the uncertainty that the Secretary General was highlighted, and that's been created by trade tensions, and affects all countries beyond US and China, then we double the cost to GDP. Altogether, what that means is that the heightened trade tension could decrease global GDP by 0.7% over the next 2 years. And there's another serious risk to the global economy beyond finance, which stems from China. Trade restrictions could become a trigger for a sharper slowdown in China. Corporate debt is very high in China, and a financial correction could hit the economy. The impact on global growth would be severe. This slide shows a 2% drop in Chinese demand would further erode global trade and fuel uncertainty. It would cost 1.75 percentage points of global growth after 2 years. East Asia and Japan would be particularly affected. So, what needs to be done to avert this? Well, first, the way forward is to resolve the trade dispute through cooperation and not through escalation. There are genuinely tough issues to be addressed in the international trading system: subsidies, intellectual properties, technology transfer, state-owned enterprises, digital trade. The rules-based system designed for the world of 1995 is not fit for purpose in the 21st century, and governments need to take the lead to make good use of this system and fix it, as they pledged during the last G20 summit. Second, beyond trade, there are many things that can be done to reinvigorate growth in both the short and the long term. To start with, we need more investment in the infrastructure of the future. Inadequate digital infrastructure is holding back businesses worldwide. Only 1 in 14 people across the OECD have a fiber broadband subscription. How can you be competitive and innovative in a digitalized world without fast internet networks? The same holds true for transport infrastructure. 47% of EU firms cite the lack of transport infrastructure as an obstacle to investment. 47. And then we need more and better investment in skills. Digitalization is full of opportunities, but people cannot seize these opportunities without the right skills. Automation will affect jobs, all jobs, even high-income people jobs. But what this chart really points out is that lower-income people are the most vulnerable to losing their jobs to digitalization. So they need to be accompanied and trained to move to better jobs. And for that, governments with businesses need to improve coverage of adult training and better align training content with labor market needs. Before I conclude, let's focus a second on the European economy, which has slowed dramatically. But governments there as well have a number of options for lifting growth. Countries across Europe can and should renew efforts to revive economic dynamism through targeted reforms. And the impact, as you can see on this graph, would be large. Euro area countries with low level of public debt should take advantage of persistently low interest rates to launch new public investment. We've seen we need it. Combining this public investment with structural reforms would provide an immediate boost to both growth and wages, with even larger gains in the long run. It's win-win, reviving faltering growth in the near term, while laying the foundation for stronger and more inclusive growth in the future. So let me sum up. Growth is too weak. And the longer governments take to react, the more it will do long-term harm through lower investment, fewer jobs, weaker incomes. So first, trade disputes need to be resolved through multilateral cooperation. Second, we need to invest in the future. Digital networks, transport, green energy, and most important of all, skills. And we also need to quicken the pace of reforms to adapt competition, labor market regulation, social protection to the digital world. Yesterday, at the opening of the forum, a question was asked, which is what we can do, what can we do? Well, I think you'll hear that a lot here, but let's act together to build a stronger, more sustainable, and more inclusive world. Thank you.